So my name is Larissa Pritula. I am principal of CreoBridge Financial. It's asset management and financial planning firm. We solely focus on high net worth individuals who are subject to higher taxation. We'll help them minimize the tax, optimize their assets, and also help them with the concentrated stock position, which we'll discuss today. So this presentation is recorded. If you have any questions, let me know. Concentrated stock is carrying several strategies that you can anticipate that we can discuss today. And there is something beyond that, of course, that can be discussed in the one-on-one meetings, but we'll cover the big parts of it. So how do concentration stocks usually build out, risk and drawbacks of having the stock, 4 ways to manage the diversification out of the stock, and sample allocation. So we'll discuss that. So when you look at your overall portfolio, it's always good to know how much in general you have as a percentage of concentrated stock in your overall allocation. Example would be, let's say you have a $1 million total portfolio, and your stock, whatever that is, let's call it Apple as an example, represents 40% of it. So $400,000 Apple stock. Is that a good concentration? Is it a bad concentration? What does that look like? So generally speaking, industry-wise, if any concentration exceeds 20% or more of your overall portfolio allocation, you consider it to be not fully diversified. So for some people, I've met the clients whose single stock represent 88% or 90% of their portfolio. For others, it's 20% or less. But somewhere between 20 plus, it becomes an issue because the concentration of single stock creates a risk of non-diversification, right? How people get there through various things. Majority of them getting through RSUs, restricted stock units, that is part of compensation, and appreciation of the stock. As the stock appreciates and you continue holding on to it, you're creating wealth, but at the same time, you're also dependent a lot on a single stock, on a single company performance. Sometimes it could be an inheritance. It could be that you own the stock for a long time and it's just appreciated over time. You don't know what to do with gains. And this creates lack of diversification over time. And we'll talk about the pros and cons of owning the single stock. One of the benefits of owning the good single stock, if we ever knew which stock would be good for next 30 years, it would be that you're creating wealth pretty quick. The disadvantages if the stock goes belly up or does not perform well, you're kind of losing your wealth pretty quick as well. So this is an interesting statistic that 68% of US stocks have experienced decline of more than 70%. So the question is, can we as an investors and people who are trying to retire at some point and live on our assets afford 70% decline? And if that decline comes soon before retirement, that could be devastating to your retirement readiness. So controlling the risk of single stock is extremely important. Creating portfolio, particularly the one that's fully diversified between US and non-US stocks, would be something that we will today uncover and discuss. So how much should you hold long-term in one stock? And what do you do with the stock? So obviously you can sell. There's 4 strategies, but there's more than 4, obviously. But the major ones are sell outright, defer. We'll talk about that, deferring the stock sale in the future through certain strategies, overlay, and giveaway. So let's start with selling the stock. So share prioritization. So when you have a single stock and you have several lots or several grants that have been given to you through the years, you have a different purchase price, right? Every time you granted an RSU, so you have a different price of the stock at the time it was given to you. And then everything on the top of, the difference between the purchase price, we call it, and the price that currently is at the fair market value would be your capital gains, either short term, if you held it less than a year, or long term. So when we do consider selling the stock, we looked at the price and the time it was given. Non-qualified stock options work a little differently. They have a strike price that you need to buy a stock at first. and then you hold it. So, but in general, there is always a price at which you acquire. It could be zero or could be some dollars that you paid for it. So stage diversification means that you identify a number of lots and shares you want to sell over time that generates gains. And then you try to control these gains through various strategies. One way to control the gains is to ask yourself, how much gains can I realize in particular tax bracket? Let's say if your income as the family together is less than $98,000 taxable income, you pay zero capital gain tax. So whatever you realize that year will be subject to zero capital gain tax on the stock sale. Anything between, let's say, $100,000 to $600,000 for married filing jointly, any gains associated with the sale that year that falls within that $600,000 territory, including other income, that gains will be only taxed at 15%. So now we start to stagger and see how much gain we can realize, what the price, what the timeline we can realize, and start planning. So when you do that, you incorporate certain tax strategies to stay within certain brackets, to realize certain gains in certain stocks. You have full control over it, right? How quickly you sell, how much you sell, how much gains you realize, because you know the fair market value today, you know your cost basis, you know how many shares you want to sell. So that's one way, simpler way to do it. I'll give you an example of the outright sell. So married filing jointly, they have $2 million in marketable security, and they want to sell most of it. So if the cost basis is pretty low, it's 300 some thousand. So if you sell everything outright, $2 million, then you only can reinvest 1.258. So you're reinvesting only the difference between what you paid. So you're basically losing 37% between federal and state tax, assuming that we are in state of California. So there will be a lot of tax to pay. So almost 40% of the money will go to tax before you can reinvest it. Simple strategy, great, but you're losing quite a bit of money because you're only reinvesting 63% of the sales proceeds. The rest goes to Uncle Sam. So let's see the difference. What can we do? How can we control the tax bracket and the tax burden? So one way to do it is to create a diversification plan based on your taxes every single year and reevaluate how much you want to sell. So instead of selling $2 million, now you sell in 1 year, let's say 500,000. The following year, maybe your income goes up or down and you adjust how much you want to sell to stay within certain tax brackets. So year 1 through year 5, you have a concentrated stock diversification plan where you plan the capital gains. Once you diversify out, so you can see that it does take time to diversify, but it's also advantageous not to sell everything in 1 year if your stock is solid, because you will not be subject to extra taxation. Example is if you sell the stock amount large enough and you're pushing over $1 million total income, including capital gains, you have another tax. It's called mental health California tax, another 1.5%. So we need to always know what the tax ramifications of a sale will be before we proceed to sell. So eventually you move that concentrated stock proceeds into diversified portfolio. This example is 60% stocks, 40% bonds. Now you have something that has more predictable ups and downs and it's fully diversified, which we call it the only free lunch we have on the stock market, where diversification creates that chance for you to maintain your portfolio value and have some sort of reasonable average rate of return that you can anticipate, right? Because if we look at 60-40 portfolio in the last 100 years, we know that this portfolio probably can make between 6 and 8% a year. So now you can plan your retirement distributions based on the notion that if your portfolio is making 7% and you're taking only 4 or 5, you're still maintaining the portfolio value with inflation. So this is an idea behind selling. Let's look at the sample allocation. So this is basically says that whatever you sell, you don't put back into stocks. You can put some into stocks and some into bonds and eventually get to your 60-40 allocation. Also, there is a way to reposition your proceeds in something called separately managed accounts or ETFs on other funds. Separately managed accounts is basically a bucket of stocks, and we will call it, let's call it S&P type of stock. Let's say you hold 300 stocks that represent S&P 500. What you can start doing with that 200 to 300 stocks is you can do direct indexing, means you basically hold the shares that represent the movement of S&P and the same risk level. But because you own individual stocks, if the market moves and certain stocks goes below your purchase price at the time of reinvestment, when you did after your concentration has been diversified, you have $500,000, you put it on the market drops. So you will have a paper loss, right? If you hold it long enough, it will recover and you're going to make money. But let's say at that time you decide, okay, you know what, I'm going to do a strategy that allows me to loss harvest. The shares that went down in value now below my purchase price, I'm going to sell and I will replace it with the similar identical stocks. Example is you sell Procter & Gamble by Johnson & Johnson. By doing so, you realize 5,000 worth of losses. Well, guess what? These losses now will offset the gains that you just realized in that single stock. These losses will be carried forward if needed. They can offset existing gains and can really reduce your tax liability. So in a year where you sold your stock at a good price, you set a limit order executed, now you're on the hook for $200,000 worth of gains, you're working through the whole year to do loss harvesting. You can definitely do it yourself, or you can do it through the algorithm that other companies, investment companies, provide. And you can loss harvest very efficiently. Every time market moves and there are some losses, the algorithm will help you loss harvest. In a year like 2020, 2022, this loss harvesting idea saved a lot of tax for clients. And all of those losses that have been realized now, not on paper, but in reality, that can be reported on a tax return, can be carried forward to offset your future gains when you're unwinding out of the concentrated stock year 2, year 3, year 4, year 5. So the loss harvesting strategy is straightforward. It's not very expensive. It's easy to implement, and it's an excellent tool. Several organizations have them. They've done it. They've run it many years. They run it usually for institutional investors, for pension funds. Now these are available for individual investors as well. An idea is you continue selling out of stock, you're minimizing the capital gains through the loss harvesting. So loss harvesting is an actively managed strategy that basically puts you back into an index fund like an S&P 500 with low cost, but allows you to loss harvest every single time. When the market is down and there is the paper losses, those losses become active losses, means they can be offsetting your current gains this year or next year, it doesn't matter, they don't go away every time you sell and replace that security with something else. So it's a great strategy. It's working very well for a few of my clients, and I've seen success for others using it and utilizing this tax savings. Another strategy we'll talk about deferring. What deferring basically means is you exchanging the interest of that $2 million, instead of selling it today and only getting half of the money back into your pocket, you put that money in like a pooled fund. And that pooled fund will have stocks like Apple, Nvidia, Google, Amazon, you name it, that will represent 200 securities that closely correlated with S&P 500. And what everybody who owns the big concentrated stock will put their own stock in it. So that fund, we call it like a fund that has now holding a lot of different security, will behave like an S&P 500 and will grow like an S&P 500. But you have not realized the gains, you defer them. Eventually, 3, 4, 5 years down the road, that will be sold and distributed to you. But the gain you're going to get is going to be the gain over the total percentage you own in the fund over the total fund. So you defer the taxes, you're exchanging that and the idea that you will get the gain from overall index. Advantages of the strategy is diversification, no realized gains at the moment. You're deferring that for the later in exchange for diversified portfolio. The disadvantages is if your stock does better than S&P, you lost some money on the table. So there's always pros and cons of the strategy. But this is one of the ways for you to not realize the gains immediately and kind of push out the appreciation over time, maybe when you need the money. So deferring that does make sense for some clients and people to take advantage of it. Giveaway. Every time we think about giveaway, people think about, well, I need to be a charitably inclined, right? Because I kind of need to give the money away and I don't see them again. Great tax savings, but what if I need the money? And I just give away $500,000 worth of stock. Yes, it's great. I get tax write-off, but what's next? So in this case, we can think about a different way of giving, right? It is an opportunity to have a higher tax deduction. We will give you an example. For instance, if you're giving away $100,000 and one person lives in Florida, another person lives in California, you can see that potential income tax savings for charitable income is less in Florida. It's 37,000 versus 50,000 in California. So charitable giving in California is much more profitable. In potential income tax savings to avoid capital gains, right? Because you give up the money, it's another 42,000. So there is a lot of savings, potential savings by giving the money, but you need to be able to afford to give it because you need to replace it with some income. So I'll give you an example. There's a few strategies that people use, like charitable remainder trust, where you giving money and taking, so basically giving money in exchange of income stream, and an income stream lasts many, many years, basically replacing, it can be replacing 70 to 80% of your overall money you put away over time, but you also get a tax deduction. And the tax deduction is pretty significant because you can deduct 30, 40% of your AGI as the charitable contribution. So let's say if your adjusted gross income is roughly, let's say $100,000. So 40,000 of your charitable giving can be fully tax deductible. So that's a big tax saving. So when you give out the money to charity, you get a tax deduction. But not only that, if you structure it in a particular trust, you can also receive a lot of income. And only at the very end of your lifetime, the remainder of that money that's set in the account goes to charity. So example is you put in $1 million into the charitable remainder trust, and then you get in a very nice 50, 60,000 worth of income every year. And then you get in that income for next 20 years. So for the next 20 years, if you're getting, let's say, roughly $60,000 over 20 years, you're going to get back $1.2 million, right? That you put 1 million. But meanwhile, every year you get extra deduction on your tax return. So that's one way to do it. There's definitely several ways to do it. Estate planning becomes very important with concentrated stock because you can gift, instead of cash, you can give shares of appreciated stock to family members who are in a low tax bracket. So if they need assistance and your help, you're giving them stocks, you're not selling them, no tax liability for you. Your family member will sell it when needed and maybe pay very low income tax, if any. So that's giving away stocks to family members who are in a low bracket. It's a great idea because they can diversify out for their own needs and maybe save that money for a future house buying, for future college funding, for whatever it's needed. So giving it to charities with return of income stream, that's one option. Giving it to family members. You can also place those shares in a limited partnership and appreciation, or in irrevocable trust, because irrevocable trust is outside of your estate. So any future appreciation of your stock is outside of your estate. So if you're subject to estate taxes, that's another way for you to minimize impact of estate taxes on your estate in the future. So there is very many ways to give away. It's not just to give away to charities, it's giving away to other people, to what's important, to who is important to you, and at what amounts also matter. You can get yourself an income stream when you do this properly. So you're not giving up the principal. Yes, you're giving up the principal, but you're getting an income stream in return. And portfolio is fully diversified. Charities pay no tax on that gain, so it's a win-win. Retirement planning becomes a very important part of diversification because, let's give an example. You accumulated $5 million in liquid assets, but $3 million out of it is in a concentrated stock and $2 million in a diversified portfolio. You think you pretty much did it, right? $5 million should be enough. Your overall income needs are maybe $200,000 out of your $5 million portfolio. You figured out, I'm only taking 4% distribution rate. What can go wrong? The problem is if that $3 million portfolio becomes $1.5 million and the stock drops down in value, now you actually taking much more distribution rate out of the portfolio value that reduced from $5 million to $3.5 million. So you're taking the same $200,000 from the portfolio of $3.5 million, well, you're taking 6% distribution rate. So now you increase the risk of reducing your portfolio size over time and maybe potentially running very low on assets. So when you go into retirement, you need to be ready to create a portfolio that's sustainable enough, diversified enough, that carries you a lifetime. So in this example, if you have a $200,000 income needs, what portfolio size do you need? Never worried about single stock decline. I would say probably at least $4 million, right? So out of 5, you diversify over time. By the time you retire, you should have $4 million in diversified portfolio, and you can have another $1 million individual stock. So if individual stocks doesn't do well during your retirement, guess what? You have $4 million to get you through. And if you're taking $200,000 from $4 million portfolio, you're taking 5% distribution rate, which is reasonable. This individual stock continue to appreciate. You can also sell a little bit there, do a little bit of loss harvesting, and you're doing just fine. But you need to get there. You need to get there from $2 million or $3 million in single stock to $1 million single stock. How do you do that without paying too much tax? That's the strategy we just discussed. You can employ them all. You don't have to do one or the other. You can sell some. You can do direct indexing with some of it. You can gift. You can do charitable remainder trust. You can put it in a partnership where you get no immediate sale but full diversification. So there's very many ways to do it. If you employ 2 or 3 of them over time, not immediately, in 2 to 3 years before retirement, you should be able to get to your goal of $4 million fully diversified portfolio, low cost, transparent account that does well for you, maybe earns, if it's gross in income portfolio, 6-7% return, you're taking 5% out, 200,000 that satisfies your income, and portfolio continue to grow a little bit over inflation. So that's the way to manage it. That's the way not to lose sleep when a single stock goes down, does not affect you. Guess what? Because you have a fully diversified portfolio that takes care of you for the rest of your life. So the stock becomes, appreciation of the stock becomes less important to you in retirement. You don't rely on it. You simply just enjoy the ride of the stock. If the stock does great, you can diversify out. But in generally, you just can hold on to it for errors to take, right? Because every time there is a change of generation and it always go from one generation to another, if it's a marketable security, you get a full step up in basis, including your house. So definitely encourage you to think, consider what might work for you specifically.